Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY the Qs and IWM. Today I've also got 4 additional trade ideas for us to check out towards the end of the video, so definitely stay tuned for that. Let's kick things off with the S&P sectors as we always do, looking at who was leading, who was losing, and where was the weight. The XLC for the communications sector led the pack today, up 2.82%, whereas the XLP was down at the bottom of the barrel, but still up, but only to the tune of 0.03%. As we know, the XLP is more defensive in nature, so nice to see that towards the lower end of our list as we saw a gap and go on today's session. And the XLC is certainly heavier in terms of weighting. It's in the upper 50% of our S&P sectors as a whole, but definitely not the top 3 that we're watching. In terms of those top 3, of course, we have the XLK for the heaviest weighted sector of them all, the tech sector, up 2.22%. The XLF for financials, second heaviest weighted sector, up 0.64%. And then the XLV for healthcare here, third heaviest weight, up 0.77%. So nice to see these heavier weighted sectors, the XLK specifically, closer to the top of our list here. Let's check in on the charts though, and just make sure that risk isn't mounting in one place versus another. The XLK continues to look fantastic here. Remember, we were discussing this bull flag right here, certainly breaking out on today's session and taking us for an equal high to the lower high that we had from here to here, correct? So to me, that's a really important move, and the fact that this gap is holding, it didn't fill on today's session, is telling you something about the buyers, right? They're really strong here. Or you could look at it in the sort of flip side of the coin and just say that the sellers aren't really stepping up at these levels, right? So if we can recapture this big, let's try that one more time. There we go. This big area of prior support, which led to that accelerated sell-off, 164. If we can recapture that, then fantastic. We are definitely making strides in the right direction for the tech market to start continuing in the upward direction, right? And by accepting above, I simply mean, do we pull back? Do we support at that level? Do something like that so we get a break and retest? Do we just print more candles up here? Do we spend more time above 164? That is price acceptance. What you don't want to see, obviously, is a move above. Technically, it's broken, right? But then we fall back down underneath. That is not what you want to see around 164. So we are making steps in the right direction. The chart does look promising. The pattern looks fairly good as well, with the bull flag breaking out to the upside, the gap not filling. It all looks good, but we still need to get up and over 164 before I'm entirely convinced that the XLK is moving back into bullish territory to maybe just slightly more neutral territory from being bearish, right? If you do something like this with a resistance trend line, the secondary, that certainly is broken on today's session as well. To the downside, right? Let's say we get a rejection off of 164. I ideally want to see it hold up above the gap fill area around 160.77, because if we fall back down into that 4-day or 3-day area of balance, traditionally, the target is the low end of the range. That puts into play an equal low, just sort of building negative progress, right? We want to continue to make higher lows, something like this, building an ascending triangle. Maybe the break of 164 happens in that manner. So that's the XLK. It's important to watch this one, obviously, because it is such a big part of our S&P 500. That's why we spent so much time on it today. Let's continue along, though, and talk about the XLF for the financials here. Very, very volatile marketplace, and you can clearly see this with the 100% retracement that happened here, and now the 100% retracement that's happened here. It's very rare that when you do the 100% retracement, you take out the top end or bottom end of the range, right? We didn't do it on the drive lower, and now I would not imagine that we do it on the drive higher, at least without some sort of higher low pullback first, and then a reattempt, right? Especially with the inverted hammer that's printed on today's session, I would imagine that we're probably in store for a bit of a pullback sooner as opposed to later. Okay, so watching out for something like that in the XLF. Where that goes, I'm not entirely sure. We can take out our Fibonacci's here from the low end of the move all the way to the top end of the move, and what we'll notice is that as long as the pullback respects our 38.2, which is roughly 39.60, we'll call it, we have nothing more than bull flag consolidation. Breakouts can continue into the future. It would also set up a better move to capture that sort of 100% retracement, right? Higher low pullback, consolidation, whatever, then the breakout can happen in a more sustainable fashion. So that's what I'm seeing in the XLF. It doesn't look like it's posing a huge threat to the S&P 500 at this point in time. Pullbacks are healthy, or at least they should be. Remember that, here looked like a solid move to the upside, and look at what the pullback did, right? So it's not a guarantee, but it does look good for a higher low pullback at this point in time, based on kind of what has been unfolding over the past couple of days, weeks even. So that's the XLF in a nutshell, not posing a huge threat to the S&P 500. Let's take a quick look at the TNX while we're talking about financial things. So this is the 10-year Treasury, of course, our interest rates here. And I want to point point something out. Maybe I was a bit unclear about this in the past, but we always sort of say, right, that as interest rates rise, it's really going to hurt your XLK. And I should sort of clarify some of my own thoughts and my messaging on this in the past. Usually it's the initial shock and awe. When the Fed comes out and decides that they will support a higher interest rate environment, that is what hurts the XLK. It's not necessarily the fact that the interest rates continue to move higher or something like that. We're just under the assumption now that with the Fed backing the decision for higher interest rates, we're going to discount the dollars in the future, right? A dollar today is worth more than a dollar in the future, right? Maybe it's worth, and again, I'm not saying inflation is going to be 50%, but we get the point, right? A dollar today is worth more than a dollar in the future. So when the Fed supports that type of activity, that initial sting is what hurts your XLK market. Once we sort of adjust and come to understand, yes, interest rates are going to rise, it's not like that pain will last forever. So I want to bring up this little graphic. You can find this over on Fred. Let me go ahead and switch the color here. Let's try that one more time. There we go. So there's your source, Fred, in the bottom right. But basically, there's only been one instance where the S&P returned a negative yearly return, or time date return, as interest rates actually rose. You can see the starting rate and the ending rate in this column right here. And every other time that the Fed has supported a raise in rates, notice what the S&P 500 does. It actually returns pretty good, solid numbers. And you can see that. It's empirical data. We can't argue with that data. So I wanted to clear up my messaging around some of the things I've said in the past about, hey, as rates raise, it means that the XLK is going to like bleed out and go to zero. Not necessarily the case. It's usually just the initial sting of the Fed supporting that activity that hurts the most. So as this has risen, we've obviously seen that the XLK has also broken out of its flag, right? So continue to just monitor this. It's going to help the XLF, obviously, with higher rates. Again, we've talked about the breaking point where at some point in time, it doesn't really become worth it for people to borrow. There's no incentive to borrow. The rates aren't low enough. And sure, the banks are making more money, but they're initiating less loans, right? So that will still be in effect as well. But as of right now, the TNX, in my estimation at least, it has fallen off. It's not really the main thing that people are focusing on right this very instant. The correlation between this and what's going on in the XLK and the XLF is not as strong as it once was as these initial moves were being made, right? In the marketplace, it's all about knowing when things are going to sort of pair up and when they're not going to pair up. And because this is not in the mind's eye, the public eye of the market right now, at least, I don't think it has as big of a correlation for all of the reasons that we've just discussed in this little snippet here. So those are some clarifications on my thoughts of the TNX. Let's continue along, wrap up our sectors here with the XLV for the healthcare sector. What you'll notice here is that the pattern looks fantastic. Again, bull flag breaking out, holding the gap on today's session. Sure, we're at the daily 50 SMA, but overall, we have a new higher high, thus starting, now that we have two lows to make a higher low, now we have a higher high, we technically have a short-term uptrend on our hands in the XLV, so things are looking good here. As I've sort of been pointing out in the past, I still think the show is between the XLF and the XLK. This is sort of taking a tertiary seat, and again, it's just not providing any drag right now. I'm not seeing a huge threat to the S&P 500 as a whole. Before we move over to the SPY, let's take a quick look at volatility, so the VIX, and what you'll notice here is that we did fall back down underneath that 2050 sort of ceiling on today's session, right? We were talking about in the past, if I just go to a weekly time frame chart here, that there was potential because we were sort of exploring that VIX 40 on the most recent downturn that, hey, maybe we're in for a wild ride in 2022 and we get something that looks like this, where 2050 becomes the new floor, but on today's session, we did technically break back down underneath it. Now, it's not to guarantee that we rotate all the way back down to 15. We, of course, know that this is still a fairly high volatility environment, but nonetheless, it doesn't look like we're going to clearly form a floor around 2050. So that sort of risk is kind of off the table for now, just looking for volatility to continue to come down if the market continues to break out. So let's just take a quick look at our S&P now, talk about tradable levels here and what that would mean. So there's a couple of things I want to point out that'll clean up the chart, then we'll discuss scenarios here. We can clearly see that the resistance trend line has been broken to the upside on today's session. That's a bullish thing. We're going to remove that from the chart. The other thing is that this prior flush point, which we've been discussing en masse on the channel for the past couple of weeks now, that is now going to be replaced by the top end of the 4-day balance and also the bottom end of the gap. Hopefully you can see why it's so close that this is much more important than these prior levels in here. And of course, it's going to coincide with the gap that held on today's session. So now that the chart's a little bit cleaner, let's talk about scenarios. We have this area of balance balance. And when we get balance, the next typical move, at least, is an area of excess. And we're starting that on today's session. We'll see if we can continue that. The first major thing to contend with is the daily 50 SMA and this horizontal level from in here, around 460, we'll call it, just for round numbers sake. To me, that seems like a very likely target into the remainder of the week, if not slightly higher. If we start to push above that, notice that this was just an area of chop, right? There wasn't a whole lot of market direction in that overall area. So I would play it sort of bar by bar, intraday sort of supports and resistances only, and not be overly aggressive pushing your luck to the upside or the downside when we get in there. Could be a wild ride, could be fairly choppy in there. There's nothing in terms of structure that's jumping off the page that's going to give us a clear target other than the top end of the range up there at 470.50. Now, I don't want to be overly aggressive and say that that has to be the target, but it is the next structural area of resistance that we have to pay attention to. So that's the number we're going to go with. That's the upside here. I would favor the upside because of the sectors and how we sort of talked about how that's unfolding, but also think about the gap and what that means, right? As we gap up, there's an imbalance of buyers and sellers. Traditionally, once that happens in the overnight, you get some sort of corrective activity, and then maybe after the gap fills, you hook for the move back higher, supporting at the area of balance highs. It didn't happen. So again, that's indicating to me at least that the sellers are fairly weak or the buyers are just too strong and are overpowering those sellers. So a good sign of strength, the fact that this gap did not fill. And you may be saying, well, hey, doesn't that mean that it's got to fill at some point in the future? Well, not all gaps have to fill. And here's some examples of that as well, right? Sometimes rallies can certainly start that way. Notice that these gaps from in the past, 1, 2, 3 of them, really kicked off this leg higher in the marketplace. So if we start to get people who feel like, okay, the market's finally starting to turn, maybe we're going back to all-time highs, they have cash on the sidelines, those people turn into buyers here. They don't want to miss the move, and you just get something that looks like this. Maybe there's more gaps to come in the future, and this ultimately does not fill. So don't be overly concerned about the lack of the gap fill underneath us. Sure, pay attention to it. Of course, carry it forward in your narrative, but don't be overly concerned that the gap has to fill to the downside. Of course, that's the upside case. We can't ignore the downside. We are technically still well below some of those highs from in here. We only have an equal high so far. We don't yet have that higher high. So let's talk about the downside. Obviously, if we break today's low, you're looking for the gap to fill 452 as we've discussed. It's also the top end of the balance. To me, that's the must-hold area. If it starts to break, then I would expect a rotation to the bottom end of the 4-day balance, which is roughly the neckline of this pattern from in here, around 443.50. That's the downside case. I wouldn't really expect much worse than that into the end of the week if we even get downside in the first place. As we've mentioned, things are looking a little bit more bullish than bearish. Let's check in on our internals now. Taking a look at this screen, if you're not familiar with this screen, get familiar. Top right-hand corner is going to tell you what this is, how to set it up, and how it'll help you make better intraday trading decisions. First thing I want to point out is that obviously on Monday and Tuesday, the marketplace, sorry about that, really just saw a ton of balance. So we're not going to read into the internals reads too much. Sure, they were bullish on Monday and Tuesday, both here in the advanced decline line as well. Negative in terms of our ticks, but working back to 0 on Monday, fairly flat on Tuesday. Nothing to really write home about there. But of course, on the breakout day, that's where we care about the internals here. Are they supporting the underlying move? And absolutely they are. 300 million was achieved in terms of volume. The breadths were fantastic throughout the entire intraday session. The advanced decliners were well up in trend zone, and we have a solid cumulative build on the day. Granted, it would have been nicer to see some more net positive bodies up here, but nonetheless, still supporting the move higher. So I'm not seeing a ton of divergence in the internals. I would say that we should have more confidence in this move higher instead of less, or be skeptical of it in the first place. Let's take a look now at the market profile. Again, I've got another video for you, top right-hand corner. If you don't know what this is going to tell you what the terms are that I'm about to use. This is just going to clearly illustrate that we had this area of balance. We've broken out of it to the upside here, and the point of control is sort of moving outside of that, right? Let's say that this would be a little bit more telling if we had a bit different of a profile, but let's say that we didn't gap. Let's say that we left something like this on the profile. There was something like that. If the point of control was like here at the top end of the balance, that would be extremely concerning. But because it's outside of the area of balance, that checks out as, again, being a better sign of confidence. Now, is it the best sign of confidence? Not particularly. It would have been nicer to see this point of control flip to higher in the day. Nonetheless, it does mean that there's a substantial, position that was initiated in here. And if those people are buyers, they're feeling confident about their position, right? They're all now technically feeling good. They're in the green on that particular trade. I will point out that we did get some balance in terms of the structure of the profile. It's not like we have a long P-shaped profile indicating short covering or a B-shaped profile indicating liquidation break. Just fairly balanced, right? So to me, a healthy move here. It's not like there's a ton of emotion tied up in this marketplace right now and we're due for like major whiplash. Again, fair price acceptance higher. Everything's checking out from what we've seen so far. I would say that the lows here aren't ideal. We don't have like an excess low. It's not quite a poor low. I would start to classify it as a weak low, actually, noting that it's almost the exact same area as the overnight point of control, overnight high. So just carry that forward. And again, we know that anyways, because that's where the gap fill starts to happen underneath. So no big surprises from our profile today. Let's go back on over to the platform here and round out our broad market with the QQQ and the IWM, of course. Zooming in here, once again, just going to clean up the chart. We know that the secondary resistance trend line has broken. Just like in the S&Ps, we have a gap. However, we know that there's relative weakness here. We did not make it for an equal high on today's session, topping right out at the daily 200 SMA, the green line here. We still need to make it to at least 369 for the potential for an equal high, if not higher after that. If we start to roll over early, maybe that's a little bit more of a bearish indication for the broader marketplace as a whole, just noting that we will continuously have lower highs. Although it's a very nuanced lower high, it would technically be a lower high. Now, do I think it's likely? Not entirely. Again, based on all of the same psychology that we discussed on the SPY, we have this area of balance, this area of range compression. Now we should be in store for an area of expansion, right, where we release that energy that was building up in that 4 or 5 day area of balance. So to me, it does look more likely for higher. We know that the equivalent of the 452-ish area in the SPY is this right here in the QQQ, closer to 378.50. So there's still a lot of work to be done if this is going to quote unquote catch up to the S&P 500. But for now, I'm liking the pattern, right? I'm liking it for higher, one step at a time. 369 break does get me much more excited and interested in longs inside of the tech sector here, looking for that to perk back up. Again, just like in the S&P 500, if this rolls over, of course, your first line of defense is the gap fill area. If that breaks, it's all about 354 in the QQQ. That level has not changed. And again, things to me at least would seem that we're going higher, not lower. Let's talk about the IWM to just round out the broad market here. Then we'll get into those trade ideas. This one is also kind of just like, let's zoom in on that one more time. There we go. This one's more like the XLY, right? Consumer discretionary, breaking out up and over the area of balance finally, whereas all of our other sort of big market indexes there have already broken out. So here we have this higher low. We had these flat highs breaking out, holding the gap underneath. Things do look good for potentially higher. The one big concern in the IWM is the 208 level. And just to put this on a weekly to remind you here, you'll note why is obviously it was the big area of support from in here. Is it going to produce a lower high for something that looks like that in the grand scheme of things? I don't entirely know. So IWM, I'm taking it one step at a time. I'm keeping a very close eye on it on a intraday basis. If we come into that level and we start to roll over, I would probably be a little bit more reluctant to be aggressive to the upside in our other two market indexes there, the QQQ and the SPY, of course. So treat this area with caution. Obviously, if it just blasts right up through it, that's going to give you more confidence in the SPY and the QQQ, and you should probably look to be more aggressive because we would technically have a look below and fail. Let me draw that in for you. Here's our area of balance. Look below, fail back in. We know that the target should be the top end right there, just like we had in the past to the upside. Look above and fail. Target was the bottom end, right around in here. So that's what I'm looking at in the IWM. We are coming into that 208. It's really going to be a make or break level for this particular marketplace. Let's get into these trade ideas now. And the first one's going to be on NIO for NEO. And if we zoom in here, fairly straightforward on a smaller time frame, like a 30-minute. This is definitely an inverted head and shoulders. Here's a neckline. You could also just look at it as an area of balance here. But what I like about it is that we've closed in this gap from in the past. So if we can get some continuation on tomorrow's session up and over today's highs, there's some room to run up to about 27.20, about a dollar-ish move, depending on your entry and what makes sense on tomorrow's open. So that's a bull trade idea here. I wouldn't really look to play it short. The only short idea would be technically look above and fail, something like like this. If we cross back down under the neckline of the inverted head and shoulders, around 25, the target would be the right-hand shoulder low, around 23. Okay, so that's one potential downside play, but I'm not really liking it, especially with the increase in volume. Notice how volume's ramping up here as we're breaking out. We also have higher lows over the past couple of days. I'm looking for the gap to fill overhead, essentially inside of NEO. Next up, we have INTC. Oops, spelled that backwards. INTC, there we go. And this one is another gap trade, but more off of a double bottom. You can clearly see that pattern right here. We're testing the neckline and notice that there's a gap to fill right around in here up to, let's roughly throw that level on. Let's grab the other tool and try that one more time. Here we go. So the gap fills up to 50.75 roughly. So what would that be? About a 75-cent trade. And then anything above that, you can clearly see the next area of structures around 52. That's really the range you want to be trading for. Just be mindful of the gap fill area. And it's completely reasonable given the size of the double bottom, right? So traditionally, if you look at this as a range and you double that range, there's your target easily taking us to about 52. And again, it's not to guarantee it gets there tomorrow or the next day, but over time, if this double bottom pans out, if we can recapture that neckline here, I do think we mosey on up to that 52 level. Not interested in the trade if we never break it in the first place and just kind of hover sideways underneath 50, the nice round number. Next trade idea is going to be on RBLX for Roblox. This one seems to keep coming up on the channel. And what we have here is another double bottom, but with a better higher low on the right-hand side of the bottom, right? So you can clearly see the neckline closing above it on today's session. If earnings is going to act as sort of a positive reason, and again, the stock market always loves to find any sort of reason to make any sort of move. If that's going to act as a positive reason, clearly next area of support or resistance rather is coming from prior support, then flipping to resistance here around 80. So about a $10 move available here inside of Roblox if we get that follow through on momentum into the end of the week. Notice how volume increased on today's session. As long as volume's on par with what we saw today or even greater, definitely looking for that continuation move off of the double bottom here. Not interested in the trade if we fall back down under the neckline. I would be willing to give it a little bit of wiggle room, something in here, as long as it consolidates, giving us higher lows. Fine, look at it as an ascending triangle at that point in time. Maybe the breakout comes in the future, but if it wants to take this level out right here, roughly 63.40, not so interested in the trade. You could maybe even adjust that a little bit lower. Let's go ahead and do that together, actually. Oops, we want to just activate it. There we go. So maybe if we start taking out those lows closer to 61, that starts to become a little bit less attractive. So that's what I would watch out for here inside of Roblox. Again, it's been on our radar for quite some time now. We'll see if this is actually the time that it wants to make its move. And then next up, we have SPOT for Spotify, of course. And this one just giving us a simple area of balance, exactly like what we've seen in the marketplace over the past couple of days. This one just seems to be the laggard, right? So if it wants to break out, what does a range double do? It fills the gap overhead. So I like that from a structural perspective, taking us to about 187.87. Anything above that, we have this prior structure to contend with, around 207, maybe 200 psychological axis number in between as well. Not really interested in the trade if it just wants to chop around sideways in here, or if it takes out the lows, I would want to see some other type of pattern emerge in the future that we could then use to initiate a trade inside of Spotify. So that is going to wrap up the video. If you enjoyed it today or learned anything new, let me know in the comments section or by giving the video a thumbs up. Don't forget our secondary channel is linked down below in the description. And all of that being said, I wish you a green trading week.